Once a purchaser has bought their property and set themselves up in a loan situation, we can then start to look at strategies associated with the repayment of the loan and the impacts on equity over time. House loans, mortgages, are typically made by way of principal and interest repayments, what is known as credit Foncier loans. In a credit Foncier loan, the principal and interest is repaid as a constant repayment over time, and the monthly repayment consists of partly principal repayment and partly interest payment. Overall, the repayment of principal starts off very slowly but accelerates over time, as is shown in the red trace in the graphs on the right hand side of this slide. If price levels are relatively stable, the increase in equity over time tends to be the mirror reverse of the principal line, and this is shown in the green line on the upper graph. And this shows equity starting off as negligible and increasing at an accelerating rate until it reaches 100%. This would suggest that it takes quite some time for equity in a property to rise to a significant amount, leading to the conclusion, which most people hold, that investing in real estate is a long-term investment. However, most of the standard presentations found in textbooks and other advice on property strategies ignores the reality of capital growth over time. Where the property market is rising strongly, equity tends to rise along with it. And because the loan remains constant, if not slightly diminishing over time, a rising property market means that the equity situation for the borrower rises far more rapidly, especially in the early part of the loan, than is apparent when property growth is not taken into account. This is shown in the lower graph on the right of the slide as the green equity line, which now is shown to be concave downwards. And that is, equity rises very quickly in the early parts of the loan. This reversed behaviour of equity is a factor that came into the market from about 1970, and it has led to a belief in the market that property investment is actually a short-term benefit, and for investment purposes, especially relying on the negative gearing strategy, this early increase in equity has meant that investors can take out the equity early on by borrowing more against the property to finance usually other investments, but even other expenditure. This strategy of mortgage release is now quite well entrenched, but it's important to recognise that it rests on the assumption of strong capital gain over time. It has been mentioned earlier that for commercial investment loans, it is an advantage to take interest-only loans, that is, loans where the repayment is only sufficient to cover the interest cost per month and not pay off the principal. This is because it postpones the repayment of principal, which is not tax deductible, off as far into the future as possible, meaning that the eventual principal repayment is made with devalued dollars in the future due to inflation. Whereas for personal borrowing, the advantage is to pay off the loan as early as possible, and hence the credit Foncier strategy is an advantage, because this strategy enables the earliest possible repayment of the principal. For borrowers wishing to repay a loan as early as possible and manage their credit Foncier loan most effectively, especially for owner-occupiers buying property, it's important to model the effects of various ways of repaying the loan earlier. The advantages of modelling loan repayment can be illustrated by looking at the different impacts of a lump sum repayment depending on where it is made through the term of the loan. In this example, we're using a current interest rate of 7.43% on a loan of $180,000 taken out over a 25-year term. If we assume that the borrower has $10,000 that becomes available to pay off the loan, we can look at the benefits of this lump sum repayment depending on when the $10,000 becomes available. If the $10,000 is paid off in the 20th year of the loan, the net saving is $14,139. That is, the $10,000 returns a benefit in terms of loan savings of $14,000, or a clear saving overall in the loan of $4,139. If, however, the $10,000 is paid off only 12 months into the loan, the net benefit is $42,000. In other words, the early repayment of the same amount is actually 10 times as beneficial to the borrower. The graphs on the right hand side of the slide illustrate the two repayment strategies and also the impacts on equity. Obviously, for an owner-occupier, the earlier a lump sum can be put against the loan, the more valuable it is. For that reason as well, any early repayment, no matter how small, is very effective at returning savings to the borrower. This can be illustrated by looking at modestly increasing the level of repayments right from the very beginning. Taking the same basic loan, it can be seen that by increasing the monthly repayments by a little over $100 a month, or about $25 a week, the overall net saving, and that's after taking out the extra cost of the repayments, is very close to $50,000, or more than 25% of the principal of the loan, and a time saving of 5 years. Again, this is illustrated by the graphs of repayment and equity. For most people, an extra $25 a week is not an insuperable sum. It equates to a couple of packets of cigarettes a week, or perhaps a few litres of fuel in the car. However, the savings are quite considerable. In addition to the savings, this strategy has some other benefits as well. The benefits of the strategy begin almost immediately because they reduce the principal at a far faster rate, as shown as the gap between the red line and the blue line in the graph. This means that even if something happens in the future, say interest rates increase, the borrower has already reduced the principal of the loan, and therefore the rate increase in the future won't have such a strong effect on them. If nothing else, by paying off the loan at a higher repayment, the borrower already has developed the discipline through the experience of paying off at the higher rate, meaning that if the interest rate does go up and the bank starts to ask for a higher repayment, it won't make any necessary difference to the borrower's lifestyle. For this reason, when borrowers approach the bank not using their entire debt servicing ability, but their debt servicing ability based on a interest rate regime, say 1% above the current market level. They stand to benefit in two ways. Firstly, by looking at the prospects of reducing their loan significantly in terms of time and cost, but also in terms of reducing their exposure to possible future interest rate rises, which for many Australians over the last generation has been a serious worry. We can now summarise some recommended borrowing strategies. The easiest strategy is to approach the bank to borrow the amount of money that could be supported by the debt servicing ability of the borrower if interest rates were 1% higher than they are at present. This would mean that if the borrower computes that they are able to pay, say, $2,000 a month towards repaying a loan, rather than going to the bank to find out what principal they can borrow on today's interest, they compute that possible principal worked out on the basis of interest rates 1% higher. This 1% buffer will reduce modestly the amount of principal that they are able to borrow, and therefore cause them to buy a slightly more modest property. But the benefits in terms of long-term advantages are considerable. The second objective is to borrow a minimum for personal use and a maximum for commercial use. In some cases, this can be managed through the way that an individual funds their business, where the business is run through a proprietary limited company. Thirdly, when choosing between short-term lifestyle and personal principal repayment, it's always better to aim to live a little simply for the short term, for the long-term benefit that will be returned as a result of being able to repay the loan early. Generally, this can be summarised as choosing time over money, or the long term over the short term. There are a number of strategies for achieving this. These include those considered in the last few slides, but also things like making loan repayments on a weekly or fortnightly basis instead of on a monthly basis, or at the very least repaying on a 4-weekly cycle using the same amount that is applicable for a monthly repayment. And in this way, since there are 13 4-weekly periods in a year rather than 12 months, the borrower is able to make a modest increase in the repayment, which tends to be relatively painless. The overall result, especially if applied from the start, is a better long-term lifestyle and a greater likelihood of eventual investment capacity. The downsides with these strategies is that they don't maximise the short-term property purchasing capacity, which means slightly lower quality of housing for owner-occupiers or a more modest investment for the property investor. This violates the natural psychological inclinations of borrowers, and in general the opposite tends to have dominated borrowing behaviour in the past, leading to the popularity of more aggressive borrowing strategies. These are actually quite suitable for environments of sustained prosperity and high capital growth. You also tend to find aggressive borrowing arrangements becoming popular as markets heat up. It's no surprise that in the years leading up to the global financial crisis and its equivalent in Australia, what is called no-doc loans or high-risk loans became very popular. Also, strategies were being made available from banks to meet the demand from borrowers for maximum borrowing potential, and while they meet the demand, they also satisfy the bank's objectives of writing more debt. Generally, aggressive borrowing strategies rely on the assumption of continued high capital growth and an escalating debt serviceability for the borrower. These were first popular in the 1980s, but again they became popular through the latter part of the 1990s. Two examples we'll look at are slow start loans that come in various arrangements, and also mezzanine borrowing. The simplest example of a slow start loan is illustrated in the chart on the right hand side of this slide. The red line is the interest cost per month, the green line is the repayments per month, and the blue line is the principal. You can see that at the very beginning of the loan, the repayments are less than the interest cost. This means that month by month, a part of the interest is not repaid, and this leads to the principal rising month on month. This can be seen by the way the blue line is actually rising. The amount of indebtedness of the borrower increases month by month for the first part of the loan. The assumption with slow start loans is that at some point in the future, the borrower will be able to increase their debt service payments. And this is shown as commencing in year 5, where the green line jumps from the low initial slow start level to the higher level that will sustain the amortization of the loan over the remainder of the period. The repayment level that is taken on in year 5 is actually based on the assumption of the credit Foncier loan starting to be paid down from that date till the end of the loan. You will notice that the level of the green line for the remaining 20 years of the loan is significantly higher than it would have been had the loan been repaid at the correct rate right from the beginning, which would approximately be a green line starting from just above the highest point of the red line. Slow start loan is applicable in situations where the capital value of the property is increasing faster than the principal is increasing, and also where the debt servicing ability will increase quite solidly over at least the first few years of the loan, making it possible for the borrower to sustain the very much increased long-term repayment obligation. This is why the slow start loan is usually only acceptable to borrowers in periods of very strong optimism, which is the characteristic of the sharp rising period just before a property bubble. A development of the slow start loan is what was called the step-up loan. These were not common in Australia, but were found in the United States, especially during the 1980s. With the step-up loan, the debt servicing obligation begins quite low compared to the interest cost, and so the principal does increase quite solidly at the beginning of the loan. But what happens through the loan, the debt service levels are increased on regular steps, say every 1 or 5 years through the loan, and they are stepped up progressively until they reach a point where the repayment level is sufficient to be able to amortize the loan in the remaining period. Because these loans start with a debt servicing payment that is substantially below the interest cost, they are even higher risk than the simple step-up loan. They also require sustained property growth and inflation over a very long period in order to be viable. There are also other variants on the slow start loan or the step-up loan that have been found from time to time, especially in markets such as the United States. However, the characteristics of them are that they rely on increasing levels of optimism and tend to leave the borrower with increasing levels of risk. It's easy to see why, although these are found in the optimistic phase of a property cycle, they also lead in no uncertain terms to the collapse at the end of the bubble. A different approach to increasing the amount of borrowing is by a strategy known as mezzanine debt. Mezzanine lending is really a second mortgage plus profit participation. The second mortgage means a mortgage which is made on a property that already has a mortgage on it. As a second mortgage, it is far less secure than the first mortgage, or what is now known as the senior loan. Traditionally, that higher risk comes with a very high interest rate. However, the high interest rate that would be applicable for a simple second mortgage is partially deflected by the offer of profit participation. The mezzanine lender therefore has the opportunity to benefit from the loan in two ways. Firstly, by taking a secure interest repayment, but secondly, if they consider that the object of the loan is highly profitable, they have the capacity to benefit from the investor profits as an equity holder. In Australia, mezzanine lending became common for development finance, especially in the years leading up to the global financial crisis. In the United States, mezzanine lending was also used for property investment, especially in the industrial property market. The actual rates and conditions of mezzanine lending are quite complex to compute. They don't sit neatly in either the finance market or the expectations of equity return. Despite a fair amount of study, the only real conclusions that can be drawn about the pricing of mezzanine lending is that they tend to be set by negotiation and by common practice. While they have proven to be quite attractive in the good times, their attractiveness does appear to be rather cyclical. While mezzanine lending does have the capacity to increase leverage levels, they do have the curious ability to redistribute risk by placing some of the investment risk back on the lender, in that way making them take a partially equity position. While mezzanine debt has become less popular in recent times, it's likely to remain as a permanent feature of the property investment financing landscape, especially for property development in Australia. Before we leave mezzanine debt, it's useful to point to one other form of financing from banks which should be mentioned, and that is the Islamic financing which comes from Islamic banks. It's appropriate to place Islamic financing after mezzanine debt because Islamic banks take the profit participation pretty much to the limit, and they lend when they're following strictly Islamic financial principles. They lend purely by taking equity positions rather than debt positions, and in this way they offer the property investor funds but with shared risk and return. And while the funds are made available, it means that the borrower is not disadvantaged by the magnification of risk, which is otherwise their lot in conventional Western financing. We will have a little more to say about Islamic financing in a different class. Overall, we can draw some strategy conclusions related to the use of debt. First of all, debt is useful for productive applications. It's especially useful when the economic conditions are stable or positive. However, debt is dangerous when leverage levels get too high, and especially as markets become overheated. Unfortunately, the psychology of overheated markets is a situation where everyone believes that the growth will not stop, and hence it tends to be a period where the self-restraint, which would be prudent, tends to be thrown out the window. The overall strategy conclusions are a recommendation to apply caution on leveraged investments that rely on capital growth. Overall, if a property investment doesn't stack up without capital growth, it's probably foolhardy to expect that it will have significant capital growth. Lastly, avoid or minimise personal, non-productive debt. If you want to drive a Lamborghini, that will be nice, but make your money before you buy it rather than take out a huge loan to service it.